Welcome to the deep dive. Today, we're focusing on what is, I think, one of the most critical shifts happening in modern finance. The institutional floodgates are really opening into digital assets. So our mission today is to give you the ultimate shortcut to understanding this whole transformation. We've synthesized the newest data, we've mapped the regulatory trends, and, most importantly, we're going to explore the the philosophical conflicts that are shaping the future of money itself.
And that context is so crucial because for these major investors, this isn't just about chasing volatility. It's a search for real, enduring value protection. They're juggling three very different realities. You've got your traditional fiat currencies, which are, frankly, structurally designed to lose purchasing power. Then you have hard assets like gold, which, well, they offer proven scarcity. And then there's this whole new category of digital assets, which is everything from decentralized crypto to stablecoins and, even potential government-issued digital currencies.
Okay, let's unpack that immediately. I want to start with a figure that should really stop anyone who still thinks digital assets are some, niche speculation. The 2025 Institutional Investor Survey, it shows that a staggering 86% of surveyed investors, and we're talking about the big players here, pension funds, sovereign wealth funds, hedge funds, they either already have exposure to digital assets or they plan to make allocations in 2025.
86%. It's not curiosity anymore, is it?
Yeah.
A mandate.
Exactly. And when we look at that commitment, it's not just token exposure, like a tiny fraction of a percent. The survey reveals that 59% of these respondents plan to allocate over 5% of their total assets under management.
55%.
Yeah, to digital assets. And it's the U.S. respondents and the hedge funds who are really leading the charge on this.
What's fascinating here, though, is that the motivation isn't monolithic. It's not just one thing.
Yeah.
Yes, the biggest driver, and this was cited by 59%, is the expectation of higher returns.
Pure performance hunting.
Pure performance hunting, exactly. But almost half of them, 49%, say their motivation is investing in innovative technology. They're allocating capital not just for the spreadsheet, but because they believe this infrastructure is the future.
And their appetite is expanding way beyond just the familiar names. I mean, predictably, 97% of these institutions hold Bitcoin, 86% hold Ethereum, that's no surprise, but a substantial 73% currently hold altcoins.
Mm-hmm.
So assets beyond the top two. And again, it's the hedge funds leading that trend, with 81% holding that broader basket.
But this broadening appetite runs directly into their primary barrier. For all this excitement, the single biggest concern, and this was cited by 52% of investors, remains regulatory uncertainty.
Right. They need guardrails.
We need guardrails. The industry is just too big now to operate in a gray area.
And that uncertainty, it completely dictates the path forward for them. 57% of respondents ranked greater regulatory clarity as the #1 catalyst for growth.
They're practically begging for it.
Yeah, they want the regulators to just make the rules of the road clear.
And this preference for clarity, it translates directly into how they want to access the market. 60% of these investors, they prefer to gain exposure through registered familiar vehicles.
Like ETPs.
Primarily exchange-traded products, or ETPs, yes.
And the asset managers are listening. Nearly half of them, 49%, are considering launching crypto funds in just the next 2 years. And the most desired offerings.
Let me guess. Bitcoin and Ethereum.
Bitcoin ETPs at 60% and Ethereum ETPs at 56%. It's all about professionalizing the access points, making it easy for a traditional fund manager to just check the digital asset box without, having to manage private keys.
Okay, so access is being solved. ETPs are making it simple. But this brings up the more fundamental question, right? Why are these massive institutions even bothering with this new, complex asset class at all? Where does the real pressure come from?
Well, you touched on it earlier. That pressure comes directly from the fundamental flaw of modern fiat money.
The systematic disadvantage for cash holders.
Exactly. It's built into the architecture when central banks have, an unlimited capacity to create currency.
So if you're just holding US dollars in a savings account, you are structurally guaranteed to lose purchasing power over time.
Guaranteed.
Let's bring in the math nugget here because it really defines the problem. If inflation averages just 3% annually, which is a fairly moderate rate historically,
right,
your purchasing power is reduced by nearly 60% over a 30-year period.
60%.
But if inflation spikes to 7%, which we've all seen recently, your money halves in value in just 10.2 years.
Wow.
That's the relentless mathematical reality that forces savers and institutional investors to seek out scarce alternatives.
And that structural reality is why we've traditionally turned to gold. Gold is the ultimate scarcity hedge. It appreciated 74% from January 2020 to November 2025. That comfortably outpaced the 19.2% cumulative CPI inflation in that same period.
And its scarcity is physical. You can't just print more gold. The amount added annually is only about 1.5% of the existing stock. It's incredibly stable.
So gold is that slow, steady defense. Digital assets, however, they promise to solve the scarcity problem, but they introduce a huge volatility problem.
A huge one. And this is where we really hit the analytical crux of the matter. When researchers compared cryptocurrencies to traditional stocks and commodities, what they found was, well, crypto is 5 times more volatile than stocks.
5 times?
And 6 times more volatile than gold. But they didn't just accept that figure. They wanted to know why.
So they used a process called variance decomposition, which is, it's like separating the signal from the static on a radio, right?
Perfect analogy. They used this model to isolate what was driving the price moves. Was it true fundamental value, known market factors, or just pure, unexplained trading noise?
And the findings on that noise are genuinely surprising.
They really are. This trading noise, it accounts for 40.17% of the total price variance in cryptocurrencies.
40%?
40% is huge.
So for comparison, what is it in stocks?
In traditional stocks, that same noise factor accounts for only 21%. And in commodities like oil or grain, it's just 15%.
So what is that noise?
The sources suggest it's largely fueled by retail investors, people prone to fear of missing out or FOMO and the hold on for dear life, the HODL mentalities, often interacting directly with very thin order books.
Okay, so it's not just that retail traders are emotional, it's the structure of the crypto market that actually amplifies their impact.
Precisely. Unlike in traditional markets, where you have these large, sophisticated market makers who exist to smooth out price fluctuations and provide deep liquidity, the digital asset space, especially for the smaller tokens, can have much shallower order books.
Right.
So when large numbers of retail participants suddenly pile in or panic sell, it creates these disproportionately massive price swings. And that is what the researchers categorize as that 40% noise. It's price movement that's completely unrelated to the actual utility or development of the underlying asset.
That insight really clarifies the risk institutions are managing here. They aren't just betting on future returns, they're actively managing against the behavior of, uninformed retail momentum.
Yeah.
So now we arrive at the digital crossroads. This is the battleground for the future of finance. And it isn't really a fight about efficiency, is it? It's more of a philosophical struggle.
It is. It's centralized control versus decentralized autonomy.
Let's start with the centralized side. Central bank digital currencies, CBDCs.
Right. These are basically digital versions of fiat currency issued and regulated by the central bank. You hear about the digital euro or the digital yuan projects. Their stated goals are, efficiency, better financial inclusion, lower transaction costs. All things that are hard to argue against on the surface. They raise these profound questions about financial autonomy because they enable direct, granular central bank oversight over every single transaction in the system.
And that oversight capacity is what generates all the concern.
It absolutely is. It opens the door to policies that could fundamentally invade financial privacy and, control individual behavior. We're talking about features like programmed spending.
Meaning the money could be restricted as to what it could be spent on, or maybe it could have an expiration date?
Exactly. Or they could apply negative interest rates directly to your digital wallet, penalizing you for saving and forcing you to spend.
And under more controlling or even authoritarian regimes, that technology becomes immediately weaponizable.
Right. It could be used to target dissidents or block any non-state-approved transactions.
And this fear isn't just theoretical, is it?
Not at all. It's hampered real-world attempts. Nigeria's Naira rollout is a perfect example. The authorities imposed severe cash restrictions to try and drive adoption. But the move faced this major public backlash.
And to this day?
To this day, less than 0.5%, less than 0.5% of the population actively uses the Naira. Public trust is proving to be a massive hurdle.
Okay, now contrast all of that with Bitcoin. Bitcoin is really the structural opposite of the CBDC vision. It's decentralized, peer-to-peer, secured by cryptography, and most crucially, it has that hard cap of 21 million coins. Its whole architecture is explicitly designed to protect financial freedom and sovereignty.
To keep control in your hands and make central seizure or restriction nearly impossible.
And this tension isn't hidden.
No, some government officials have positioned CBDCs explicitly as a policy tool to, and I'm quoting here, fight crypto. They acknowledge that decentralized systems make it extremely difficult for regulators to monitor and enforce traditional monetary policy.
So the underlying battle is really over who owns and controls the ledger.
That's it.
So while that big ideological fight rages on between CBDCs and Bitcoin, how are institutions actually transacting today? How are they bridging the gap between fiat and these decentralized systems?
That bridge is being built by stablecoins. Stablecoins, or SEs, are the immediate practical solution that institutions are adopting very, very rapidly. They maintain a stable value, usually paid one-to-one against the US dollar.
And they are truly massive now. Their total market cap is close to $250 billion. And US dollar stablecoins make up 99% of that total. It just shows how critical dollar-backed stability is for this entire ecosystem.
Institutionally, they're an essential utility. 84% of institutions are either using or are interested in stablecoins, and for three specific reasons. 1, generating yield. 2, transactional convenience when trading other digital assets, so you avoid constant conversions back to traditional fiat. And 3, facilitating efficient foreign exchange, or FX.
And we're also seeing regulation reinforcing the dollar's role here, aren't we?
We are. Frameworks like the U.S. Genius Act are defining really strict requirements for stablecoin reserves, limiting them to U.S. currency, demand deposits, and very short-term treasuries, 93 days or less.
So this structured regulatory clarity, it might actually counter a lot of those de-dollarization fears we hear about.
It could, by making the dollar the most robust and trusted currency layer for the entire digital asset industry.
Okay, so moving beyond just holding digital currency, what's the next big frontier for institutional growth?
That would be tokenization. 57% of investors are interested in investing in tokenized assets, things like tokenized bonds, tokenized private equity, or funds.
So why are institutions so excited about this, taking traditional assets and turning them into tokens? What does that actually enable, practically?
Well, the drivers are primarily pragmatic. They're focused on efficiency and access. Portfolio diversification is the top reason, cited by 65%. But the real power, I think, lies in fractionalization. That was cited by 48%.
So breaking big things into small pieces.
Exactly. Traditional assets, especially private credit or real estate, they require huge investment minimums. It makes them inaccessible. Tokenization allows a $100 million piece of private credit to be sliced into tiny, tradable digital pieces, which lowers the investment floor dramatically.
That makes perfect sense. It democratizes access to traditionally illiquid assets.
And it enables unprecedented efficiency. When you tokenize an asset, settlement can become instant. That reduces the counterparty risk, the friction associated with these complex, long-duration asset transfers.
So what are they most excited to tokenize?
Alternative funds like private credit and private equity and commodities. Those are the most popular because they suffer the most from illiquidity and slow settlement times right now.
And finally, the ultimate indicator of utility, institutional engagement with decentralized finance, DeFi.
This number is a big one.
The data shows institutional engagement with DeFi protocols is set to nearly triple in the next 2 years, jumping from 24% of institutions today to 75%.
That is a massive tectonic shift. It really is. This tells us they are moving beyond just passive holding and into the active use of the infrastructure.
So they're not just buying Bitcoin anymore.
No, they're utilizing DeFi protocols for lending, for borrowing capital, for gaining yield on their stablecoins, and even engaging with synthetic assets to hedge risk or gain exposure to non-crypto markets, but in a digital way. This massive growth projection signals that the underlying technology is finally maturing into something that can handle large institutional capital flows and their complex financial needs.
You know, what really stands out to me from this whole deep dive is this unified theme of growth. It's driven by two forces. First, institutional capital just seeking higher returns. And second, institutional capital hedging against the systematic debasement of traditional fiat currency. I mean, we are watching an irreversible expansion.
And if we connect this to the bigger picture, the defining conflict of the financial future isn't just digital versus analog. It's the structural tension between decentralized autonomy, which is championed by Bitcoin, well-regulated stablecoins, and institutional DeFi. And on the other side, centralized control, which is exemplified by the current trajectory and the potential capabilities of CBDCs.
Institutional investors have voted with their wallets. They've listed regulatory clarity as the #1 catalyst for future growth. But this raises an important question for you, the listener. Given the historical precedent that gold ownership was once actually confiscated by a U.S. executive order back in 1933, what are the chances that this newfound regulatory clarity around digital assets, especially around centralized CBDCs, will ultimately prioritize consumer financial freedom over governmental financial control? Something for you to mull or explore on your own.